Okay, this is part two of Chapter 2 and Gregory Mankiw. And this section we're going to be going into the two most basic models in economics. So the two most basic models are circular flow and the production possibilities frontier. Now first we deal with the circular flow diagram. And in the circular flow diagram, it's really a model for the macroeconomy because it looks at two markets and two players. These two players interact with each other in the markets for goods and services, otherwise known as the product market, and the market for the factors of production, otherwise known as the resource market. Firms need households, households need firms. The firms are going to provide the households with stuff and services. Goods and services. Goods are tangible, services are intangible. Firms sell them, households buy them, and in return, households spend money on the goods and services, firms get the revenue. The market serves as the clearinghouse. The market serves as the entity that determines how much is going to be provided, to whom, and for what price. Now, in order to make these goods and services, there needs to be resources that are somehow arranged together, combined together to make the goods and services. And the resources that we generally call are land, labor, and capital. The land is everything around us that can serve as a resource that is not person-made. Labor is our activities that make land and land more productive. Labor is the actions of individuals that have a paid component to it, otherwise known as a wage. The paid component for land is rent. Capital is anything that makes labor more productive. So capital oftentimes is a machine, but capital can be as simple as a glass that holds water, and so it makes the activity of drinking the water a lot more efficient than just drinking the water straight from a stream, for example. Capital can be as complex as a computer or as simple as a pencil. Both things make the worker, the individual, more productive. Now there is payments to these various holders of the factors of production, and they are wages for land, wages for labor, rent for land, and interest for capital. Interest is because that's the payment of the loan of, let's say, investment capital. Firms will borrow money to get the capital that they need. Let's say a farmer borrows money for farm equipment, and what they have to pay back is the interest. So the interest is going to be the price of the capital that the entrepreneur is going to have to get. Now, a fourth factor of production oftentimes is entrepreneurship, but I think your book, Mankiw, focuses on these three, and these are the three standard factors of production. These three standard factors of production are used as inputs for firms, who will then sell goods and services, and then households will buy the goods and services, and then households will need to go back into the resource market and sell the resources. Firms wear two hats. They are buyers in the product market, buyers in the factor market, and sellers in the product market, whereas households are buyers in the product market and sellers in the resource or factors of production market. We wear two hats as households all the time. When we go to the store, we are buyers, and when we go to work, we are sellers, depending upon the market. So this little diagram here is a very, very a nice diagram, simple at the beginning, but it can really show exactly how the economy works. Okay, now here's a little exercise that you can do. Draw a circular flow diagram, and you can just look at the one that was in the previous slide. You can draw it with the firms and households and the markets and how they interact. Now identify the parts of the model that correspond to the flow of goods and services and the flow of dollars for each of the following activities. So Sam pays a storekeeper $1 for a quart of milk. Sam gets a quart of milk. Sally earns $4.50 per hour working at a fast food restaurant. Sally works at the restaurant. So think about this for a second and see which of the flows it goes into. Okay, hopefully you chose Sam paying a storekeeper $1 for a quart of milk under spending. Sam getting a quart of milk is under goods and services bought. So each transaction has two components. You get the item, you pay for the item. Sally earns $4.50 per hour working at a fast food restaurant. That would be income. Sally works at the restaurant. That is labor. So for the labor that Sally earns, she will get $4.50 an hour. Okay. Now we go to our second model, which is called the Production Possibilities Frontier. And this shows the various combinations of two goods that can be produced by one firm. We assume two goods, and we assume along the frontier, as you'll see in a second, something known as fixed technology and fixed factors of production. These, once you change them, are going to shift the curve, whereas changes in the two goods are going to be a movement along the curve, according to the two rules 1 and 2 that we found earlier in the first part of this presentation. Okay, here's our two axes. Axes on the vertical is going to be computers. On the horizontal is going to be quantities of cars produced. If we used all of our resources to make computers, we would make 3,000 computers. If we used all of our resources to make cars, we would have 1,000 cars. And then along this curved line here, this bowed out line, the number of computers and cars, that would be some combination of the two. Now the line is bowed out owing to something known as increasing costs. So as you move down the frontier to produce, let's say if you go from computers to cars, it's going to make one more car is going to cost more and more in terms of computers. And that's because the factors of production are heterogeneous, they are not the same. I think your ManQ book will talk more about this bowed out line later on. Chapter 3, we're going to have a straight line for this, which is going to be constant cost. Okay, point A is 2,000 cars and 2,000 computers and 700 cars. Now point B inside, as we can see here, is going to be inside the frontier. So you're not using all of your resources in their best uses. Point D is going to be outside the frontier. So with the available resources, land, labor, and capital, we cannot produce a combination at point D. Point C, 2,200 computers, 600 cars, shows that to get that extra 200 computers, you're going to have to give up 100 cars. Now again, the bowed out shape is going to mean that to get a few more computers, you're going to have to give up an increasing amount of cars to do so. Okay, and now we've got this yellow area. This yellow area is called the feasible region. This is where This is the possible combinations of computers and cars that can be produced given our technology that is available. And if we're on the frontier, we're going to be efficient. If we are inside the frontier, we're going to be inefficient. So efficiency is on the line. The trade-offs are going to be going from one point to another along the line, which is also going to show the opportunity cost. And that is going to be our next slide. Efficiency is going to be along the line. Trade-offs to get something, we're going to have to give up something. Opportunity cost is going to be the exact thing that we give up. So as you saw from point A to point C, to get 200 computers, you had to give up 100 cars. That is the opportunity cost. Economic growth. This is a change in that affects both things, that enables you to produce two things. Let's see economic growth right now. Oops, there we go. Here's the first line, and here's the second line. Now in this regard, we had an outward shift, a shift to the right of the production possibilities frontier, so there was an increase in technology to produce computers that enabled the factory to produce more computers and more cars than before. Maybe it was robotic technology that made the individual workers more productive so that they could make more of both, computers and cars. Okay, this is going to end the second part.